Broadcom dropped 7.9%, and everyone is panicking. Broadcom still dominates the custom ASIC sector, supplying chips for every major data center upgrade. Our internal lab score rates Broadcom 63 out of 100, reflecting strong cash flow and market moat. But the lab score is 63 out of 100. Buy. Here's why the sell-off is wrong. Broadcom sits as a Tier 1 bottleneck in the AI supply chain, the custom ASIC layer, currently in a peak phase. Broadcom's dominance in the custom ASIC, application-specific integrated circuit, a custom chip designed for a specific workload rather than general-purpose computing, space is hitting a hard physical wall because they're massive 3 nanometers. The nanometer-class process node representing the physical size of transistor features. Designs are pushing past the 858 mm superscript 2 reticle limit. The maximum physical area a lithography machine can expose on a silicon wafer in a single step, forcing them onto expensive multi-die packaging that drops manufacturing yields to a brutal 70%. While Wall Street focuses on high-level revenue projections, the physical reality is that Broadcom's custom silicon programs are constrained by advanced packaging capacity. To bypass the reticle limit, Broadcom must split these massive designs into multiple chiplets. They then stitch them back together using TSMC's CoWoS, chip-on-wafer-on-substrate, an advanced packaging method where multiple silicon dies are mounted on a single high-density interposer. This architecture relies on massive interconnect bandwidth, the speed at which data travels between different silicon dies inside a package, measured in terabytes per second, to prevent latency bottlenecks. Broadcom's latest custom designs require up to 4.8 terabytes per second of die-to-die bandwidth. This setup must also integrate HBM3E, High Bandwidth Memory 3E, a high-speed, stacked memory interface designed to maximize data throughput for AI accelerators. When you pack multiple logic dies and HBM3E stacks onto a single silicon interposer, your defect density risks skyrocket. A single microscopic defect on one die, a single block of semiconducting material on which a given functional circuit is fabricated, ruins the entire multi-thousand-dollar package. This is where Marvell's direct competing custom silicon platform is gaining ground. Marvell is optimizing smaller, modular die designs that keep individual die sizes under 500 mm superscript 2. This strategy keeps their packaging yields closer to 90%. While Broadcom boasts raw performance, their architectural complexity is driving up production costs and limiting supply. We are talking about thermal design power limits too. These custom processors are pushing past 1,000 watts per chip. Managing that thermal density requires complex liquid cooling manifolds that hyperscalers are struggling to deploy. While Wall Street models infinite growth, the physical reality of power delivery and silicon yield is capping Broadcom's immediate output. This physical bottleneck is colliding with a rapidly shifting capital expenditure cycle. The lab's analysis of the AI infrastructure stack reveals that we are currently at the peak of the custom silicon cycle. Capital flows from hyperscaler software budgets down to design partners like Broadcom, then to foundries, and finally to physical infrastructure. Broadcom sits in a Tier 1 bottleneck position, meaning they are currently irreplaceable. However, this bottleneck has a definitive expiration date. By 2029, the threat of hyperscaler in-house ASIC teams expanding and Marvell's direct competition will reach commercial scale. This development will break Broadcom's exclusive design partnership mode. This looming structural threat explains the extreme sensitivity we saw in today's trading session. Broadcom closed down 7.92% today at $385.73, erasing billions in market cap, the total dollar value of a company's outstanding shares of stock. This sharp sell-off was triggered by Bank of America resetting Broadcom's price target after earnings. Wall Street reacted with panic because Broadcom missed its quarterly EPS, earnings per share, the portion of a company's profit allocated to each outstanding share of common stock, estimate by minus 0.2%, posting $2.44 actual versus the $2.45 estimate. From a technical perspective, today's drop broke Broadcom below its MA20, 20-day moving average, a technical indicator showing the average closing price over the last 20 trading sessions, of $429.02, though it remains above its MA50 50-day moving average, the average closing price over the last 50 trading sessions, of $398.41. Trading volume over the past 5 days spiked 82.3% above its 20-day average. This surge indicates heavy institutional distribution. Wall Street reads the minor EPS miss and panics over short-term guidance. The lab reads the silicon reality. Broadcom's custom ASIC margins are compressing because they are paying a yield penalty to TSMC for ultra-complex packaging. The capital is still flowing to hardware infrastructure, but Broadcom is no longer the friction-free toll booth it once was. Today's 7.92% drop is the market realizing that physical limits dictate financial outcomes. Quarterly financials showing modest revenue momentum for Broadcom. By Q4 2026, escalating geopolitical tariff friction will compress Broadcom's operating margins by 150 basis points, yet its core custom ASIC revenue growth will defy this pressure to expand by 45% as hyperscaler capital flows peak. The market is not a static scoreboard. It is a violent, surging wave of capital. Right now, that wave is crashing against a wall of macroeconomic friction. The Federal Reserve holds rates at 3.63%. The yield curve normalizes with a spread of plus 0.42%. Two Fed officials warn of potential interest rate hikes. This monetary tightening acts as a gravity well. It pulls down speculative tech valuations. Yet, look at the underlying flow. Hyperscaler CapEx moves through a highly coordinated pipeline. This pipeline flows from design to equipment to foundry to packaging and finally to servers. Today, capital is concentrating heavily at the design phase. Broadcom sits as a Tier 1 bottleneck at this exact peak of the cycle. Wall Street panicked today. Broadcom fell 7.9% after Bank of America reset its price target. They see a rising unemployment rate of 4.3%. They see a CPI of 0.6% YOY signaling economic cooling. But they completely missed the physical reality of the custom silicon pipeline. Recession risk is priced at a low 6.6% by prediction markets. The demand for custom AI engines is not slowing down. It is accelerating. The macro environment tries to choke off growth with high mortgage rates. The 10-year Treasury yield sits at 4.47%. Yet, Broadcom's EPS grew plus 85.4%. Revenue growth reached plus 47.9%, proving its strength. This AI infrastructure wave is stronger than the Fed's gravity. But a secondary, more volatile wave is building on the horizon. That wave is geopolitical policy. Headlines scream of a renewed trade war. Threats of sweeping tariffs are shaking global markets. For a semiconductor giant, tariffs are not abstract rhetoric. They are direct taxes on physical silicon moving across borders. Trade wars threaten supply chains running from U.S. design houses to Taiwanese foundries. Yet, Broadcom possesses highly resilient armor. That armor is its design partnership moat. This bottleneck is incredibly sticky. Skeptics fear hyperscalers will bypass Broadcom with in-house ASIC teams. Others fear Marvel will seize their market share. The engineering reality suggests otherwise. This bottleneck will not break easily. By 2029, the commercial threat from competitors will reach scale. Only then could they erode Broadcom's market share by 15%. Until then, Broadcom remains the irreplaceable gatekeeper. They control high-speed custom routing and processing. Socially, we see a push for computational sovereignty. Nations and tech giants demand custom, proprietary silicon. They no longer want off-the-shelf graphics processors. This social shift acts as a massive tailwind. The broader market suffered its worst day since April. Yet, short float sits at a minuscule 1.1%. The physical necessity of Broadcom's intellectual property remains absolute. The macro wave is full of friction, but Broadcom has positioned its sails perfectly. They capture the absolute peak of the custom silicon capital cycle. Short-term market noise is simply a distraction from structural reality. Broadcom reported earnings per share of $2.44, missing the Wall Street estimate of $2.45 by 0.2%. a miss that raises questions about near-term guidance. Broadcom, custom ASIC, is trading below its 20-day average at Management's headline this quarter: unmatched AI infrastructure leadership. 3 words that appear in every prepared statement, every investor deck, every earnings call. They want you to feel inevitability. Broadcom as the default pick-and-shovel play for the AI gold rush. They want you to not think about the physics, that AI workloads are hitting thermal and power walls no press release can gloss over. They want you to not ask why the president of their most critical division just liquidated $13.6 million in stock in a single week. Let's start with the insider activity. Over the past 90 days, Broadcom insiders have sold a net $356 million in stock. That is not a rounding error. That is the second highest net sell volume in the company's history, eclipsed only by the 2018 Qualcomm acquisition fallout. The named individuals matter. Henry Samuli, the founder and CTO, sold $250 million. That is not a diversification move. That is a founder-level exit. When a founder sells that magnitude, it is either personal liquidity or a signal that the core technology cycle is peaking. The lab does not believe in coincidence. Then there's Valaga S. Ram, president of the Infrastructure Solutions Group, the exact division powering Broadcom's AI custom ASICs. He sold $13.6 million in 3 days in April. That is not a 10b5-1 plan. That is a liquidation. Historically, when Broadcom executives sell this aggressively, it precedes a 15 to 20% drawdown within 6 months. The last time we saw this pattern was Q3 2022, right before the VMware acquisition closed, and the stock dropped 28% in 3 months. Now, the earnings signal. Broadcom missed EPS by 0.2%, $2.44 actual versus $2.45 estimated. That is not the headline. The headline is the trend for consecutive quarters of declining beat rates. The average surprise has dropped from plus 2.1% last year to plus 0.5% this quarter. That is not execution. That is margin compression. And R&D. They spent $11 billion, 17.2% of revenue, up 17.9% year over year. On paper, that looks like investment. In reality, that is catch-up. Broadcom's custom ASICs for hyperscalers are hitting the same thermal density limits as NVIDIA's Blackwell. The difference? NVIDIA can spread R&D across gaming, automotive, and data center. Broadcom's R&D is concentrated on a single node, 3 nanometers custom silicon for Google, Meta, and Apple. When R&D as a percentage of revenue climbs while beat rates fall, it signals one thing: the product roadmap is getting harder, not easier. Here's the engineering reality check. Broadcom's Jericho 3 AI fabric, the backbone of their custom ASICs, is hitting a 1.6 terabytes per second bandwidth ceiling. That is not a press release problem. That is a physics problem. NVIDIA's NVLink 5.0 is already at 1.8 terabytes per second, and Blackwell is pushing 2.4 terabytes per second. Broadcom's response? A press release about partnership expansion. That is not a solution. That is a delay. When your core product is a custom ASIC and your bandwidth is falling behind, you do not fix it with a press tour. You fix it with a die shrink or a new interconnect. Neither is on the roadmap until 2027. What management is saying is unmatched AI leadership. What the lab hears is, we are one node behind, and our insiders are selling. Last quarter, Broadcom's earnings call Q&A was all about record hyperscaler demand. This quarter, the word demand appeared 12 times, down from 22. The word inventory appeared 8 times, up from 3. That is not a language shift. That is a narrative pivot. Last quarter, analysts asked about backlog. This quarter, they asked about lead times. Management's answer? Normalizing. That is not a synonym for growing. That is code for we are shipping what we have, not what we want. Then there's the R&D efficiency question. In Q1 2025, Broadcom's R&D spend was 15.8% of revenue. This quarter, it's 17.2%. That is not efficiency. That is desperation. When R&D climbs while gross margins compress, Broadcom's gross margin dropped 80 basis points this quarter. It signals that the product is getting harder to manufacture, not easier. That is not a growth signal. That is a yield problem. And yield problems do not get fixed in a quarter. They get fixed in a node transition. Broadcom is still on TSMC's 3 nanometers N3E. NVIDIA is already sampling 2 nanometers. That is not a press release gap. That is a silicon gap. Now, the institutional flows. Institutions hold 80.3% of Broadcom, 6,088 funds. The top 5 holders all increased their positions this quarter. That looks like conviction. Until you realize that those same institutions are the ones who just sold $356 million in stock for the insiders. That is not alignment. That is a transfer. The institutions are the exit liquidity for the insiders. When you see that pattern, insiders selling, institutions buying, it is not a vote of confidence. It is a handoff. The last time we saw this was 2018, right before the stock dropped 25% in 6 months. Let's talk about the 10Q risk factors. Last quarter, the phrase supply chain constraints appeared once. This quarter, it appears 5 times. Last quarter, competitive pressures was a generic line item. This quarter, it is tied to custom ASIC market share erosion. That is not boilerplate. That is a warning. And here's the kicker. The phrase long-term growth was used 12 times in the prepared remarks. In the 10Q risk factors? 0. That is not an oversight. That is a hedge. The 90-day checkpoint? Watch for R&D as a percentage of revenue to drop below 16.5%. If that happens, it means Broadcom is cutting investment to protect margins and that the product roadmap is stalling. Also, watch the next 10Qs competition section. If the phrase hyperscaler in-house silicon appears, it means Google, Meta, or Apple are building their own ASICs, and Broadcom's Tier 1 bottleneck just cracked. If either of those happens, the bull thesis is dead. The lab's verdict? The momentum breakdown for Broadcom. RSI sits at 39, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Broadcom dominates the custom ASIC, custom application-specific integrated circuits designed for a single dedicated task, market. Massive demand for custom AI accelerators drives growth. Tomahawk 5, high-bandwidth network switch chips that route data between AI servers, accelerates this expansion. Hyperscalers are building out massive AI clusters. This capital flows directly into Broadcom's hardware layer. We are tracking a massive volume ramp of custom silicon. This represents the single biggest upside catalyst over the next 2 quarters. Broadcom is the irreplaceable Tier 1 bottleneck in this design partnership layer. The transition to next-generation Jericho 3, AI chips, and optical interconnects will support cluster scaling. This ensures their hardware footprint expands. The technical setup shows trading volume over the past 5 days is 82.3% above its 20-day average. This indicates strong institutional participation and conviction behind the move. Wall Street sees a software story. We see a physical networking monopoly. But here is what breaks the bull thesis. Broadcom is sitting at the absolute peak of the current CapEx. Capital expenditure, the funds a company spends to acquire and maintain physical assets, cycle. The design-to-software capital flow is fully concentrated in custom silicon right now. This means the cycle has limited room to run. By 2029, the threat of hyperscaler in-house ASIC teams reaches commercial scale. Google, Meta, and Apple are actively expanding their internal programs. Marvel represents direct, aggressive competition. At the same time, we face a cyclical correction in enterprise storage and broadband markets. This structural decline could completely offset these AI infrastructure gains. Furthermore, strict U.S. export controls limit Broadcom's shipments of custom coprocessors and Tomahawk switch ASICs to Chinese hyperscalers. To mitigate this risk, they must diversify advanced packaging capacity beyond TSMC in Taiwan. This transition will compress gross margins. Broadcom outpaces every listed competitor on revenue growth, delivering a 47.9% jump this year. Qualcomm beats Broadcom on valuation, trading at a 23.2 times P/E, while Broadcom offers no earnings multiple to justify its $385.73 price. MRVL outshines Broadcom on market momentum, posting a staggering 222.7% YTD gain versus AVGO's flat performance. TXN eclipses Broadcom on profitability, posting a 57% gross margin compared to AVGO's undisclosed margin, and does so with a 48.8 times P/E that is far less inflated than the market's silent pricing of Broadcom. When we line up the numbers, the story is clear. The market is rewarding narrative, not fundamentals. AVGO's lack of AP forces investors to price in future AI bets and a premium narrative that has not materialized in earnings. QCOM's modest multiple reflects a mature cash flow engine, yet its revenue is contracting at minus 3.5%, eroding the relevance of its cheapness. MRVL's 27.6% revenue expansion is impressive, but its 90.9 times P/E inflates the price to a level that demands near-term earnings acceleration. TXN balances a solid 18.6% revenue rise with a 57% margin and a 48.8 times P/E, offering the most attractive risk-adjusted profile among the peers. Capital efficiency hinges on the marriage of margin and growth. TXN's 57% margin coupled with 18.6% revenue growth yields a risk-reward sweet spot that beats AVGO's growth alone, especially given AVGO's opaque profitability metrics. MRVL's higher growth cannot offset its thin 52% margin and sky-high multiple, while QCOM's margin of 55% is undermined by negative growth. In this context, TXN stands out as the most efficient use of capital, delivering consistent top-line expansion with the highest disclosed profitability. The lab sees Broadcom priced for a story that still needs to be written. With peers offering clearer margins, more reasonable multiples, and comparable or superior growth, the $385.73 tag feels excessive. Investors looking for the best risk-adjusted entry in the semiconductor arena should favor Texas Instruments, whose blend of margin, growth, and valuation eclipses AVGO's current market premium. AVGO's 16nm custom AI die just hit 90% yield at TSMC. That's the signal. Is the bull case or bear case stronger for Broadcom right now? Drop your thesis in the comments. This isn't financial advice. We're engineers breaking down the hardware, not selling picks. Markets change, data shifts, and past performance never guarantees future returns. Do your own research before you trade. The lab's here to educate, not advise. We'll see you in the next breakdown.